Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor and partner with HCM Wealth Advisors. I'm joined today with Doug Johnson, who's our senior investment strategist and partner with HCM Wealth Advisors. Welcome to our webinar. So if you'd like to ask a question, please go to the bottom of the screen, click on Q&A, and there you'll have the opportunity to submit your question, and we'll do our best to answer at the end of the webinar. Now, it seems like the same headlines in the news. It's inflation, the Federal Reserve, supply chains, COVID, stock bear market. Doug, these things seem to be wearing. Now we're coming up on 5+ months of this. Now add to that earnings, recession. Has there been any progress on these fronts? So these are going to be some of the questions that we're going to be answering today during the course of our presentation. Now, first though, before we get started, great screen. So first we want to alert you and let you know taxes. Through the course of the year, I know we talk in a lot of our presentations about taxes here at HCM. And a big part of what we're looking at is not being reactive. So oftentimes we see people look at the end of the year and see where their portfolios stand with taxes and do we need to make any sales or adjustments to try to reduce your gains? But that's something that we do proactive here at HCM. So we've been actively selling some investments in recent weeks and doing some tax loss harvesting. And that tax loss harvesting is to sell investments that are depressed in value, replace them with similar investments in the portfolio, keeping our allocations the same. So behind the scenes, we still have been active, but we're trying to do that to help mitigate gains later on during the course of the year. One other item I want to note, and that is 529 plans. So why in the course of now would we even talk about 529s? Well, this weekend is 529 day. So it's a little gimmicky, I know. The 529 plans jump on this and they do a lot of advertising around the date of May 29th. But 529 plans, these are fantastic plans. They're tax advantage savings plans. Actually, in fact, they can be tax-free. Think of it very similar to like a Roth IRA combined with a 401k plan. You have a cafeteria of choices to be able to invest in, to harness the stock market, and to be able to plan and invest in. Maybe it's for a child or a grandchild. And there's been some rules that have changed in recent years that you may want to be aware of, and we can get you up to speed on. So if that's something that you have an interest in planning, something you'd like to consider, please reach out to your advisor. We'd be glad to talk to you in more detail. And these can actually be, in fact, used to pay down some student loan debt as well. So we'll talk about those details, but we'll get on to our presentation. We've got a lot of things to cover today. Okay, Twinkies. Why in the world are we shifting to Twinkies? Well, before I do that, so Doug, I'm going to ask you a question related to Twinkies. So a Twinkie has a shelf life of, and I'll give you a couple choices here to choose from. So 25 days, 75 days, which is 2.5 months, or 250 days, or 2.5 years. So Doug, what's your choice on the shelf life of a Twinkie?
I thought the third answer was going to be 250 years, and that was going to be the one I selected. But I think I'm going to have to go with the longest option of 2.5.
Okay, what's funny is I don't even know that I realized that there's an expiration date on the box, but 25 days is what Hostess would tell you. I know. Now
I'm not going to lie. I would eat them after 25 days, but that's besides the point.
But I'll have to say, so I have to show you, I have not just a picture, I have a box and I have one of these little golden delights right here. And the reason we're even talking about this is a client emailed me recently, and the client calls me Twinkie Man. So I know oftentimes in the course of our presentation, we say thank you at the end, but I'm going to start off today by saying thank you. We are blessed and fortunate to have the kind of relationships that we have with our clients that somebody can call me Twinkie Man. And this started with a client back in 2001, which, if you remember, that was back during a bear market that lasted from 2000 all the way to early 2003. And I decided to go on a diet at that time, and I lost a significant amount of weight. And I went to the client's house for a meeting. And as I got to the client's house, sat down at the table, there was a huge spread of Twinkies sitting on the table there for me because they said my weight loss coincided with the drop in the market. So enough of that, get back to putting on some weight, and we're here to help you. So Twinkie Man stuck, and we still have fun with it for many, many years now. And that's what's been so fun about what we do. We've helped this client plan and navigate for retirement. We've helped them navigate around bear markets, and we've helped them buy a property in Wisconsin and eventually build a retirement home there, which they've now retired to. Now, I haven't seen it yet. My plan is this summer sometime to go up and visit. And that's another great thing that we get to do here at the firm is we help people with their plans, see where they end up going, their destinations, and we get to visit sometimes. A month ago, I got to visit clients in North Carolina, and similar situation, clients that had moved there and helping them execute their plan to retire and eventually relocate. So we've got so many stories in the firm with so many advisors, with so many families that we work with here at HCM. So thank you. Thank you for the trust that you've placed in us at HCM. Please know that we're here to help. If it's a friend, a family member, it would be our honor to help. So please don't hesitate to reach out to us. And Doug, these can also be good for stress eating when you've got times like this in the market sometimes.
So before we move on, somebody had just sent in a comment basically saying who has a Twinkie long enough to reach an expiration date, which is a very, very good poignant point.
A very fair point.
Wanted to point that out.
That's right. And a funny side note, I happened to look up Hostess. So just a quick trivia, a few years ago, Hostess went, the company Continental Banking, they went bankrupt, and you couldn't find these on the shelf for a long period of time. So they went for big costs on the internet as far as getting your hands on them. And then they eventually started baking them again with the new owners. And Hostess is actually positive for the year. So I don't know what that tells you as far as a defensive stock or stress eating stock in the course of this environment. So anyway, again, thank you, clients. It's we're so thankful and glad that we work with you. So this is a great slide, Doug. It's been very interesting when you look at with inflation and what we've seen. And this slide tells it all. 40% of the dollars in the money supply came from the start of the pandemic to now. And when you're pumping that much money into the system, it's created an enormous amount of inflation. That inflation, we need to work off that excess, and it's going to take time to do that. And if we go to the next slide, you're going to see that this is not just in the US, this is around the globe. I mean, you're seeing inflation at extraordinary levels. And you would think that with such levels that we're having, that many central banks would be tightening by increasing interest rates like the US, but this is not the case. The European Central Bank and Japan have not increased rates. Now, China's been cutting rates given the impact of lockdowns now in its two largest cities, but it's been interesting to see the approach that many of these countries, the central banks have had, giving this a tremendous amount of time for some of this inflation to work out. So hopefully that will not backfire. And a lot of people have felt the Fed has been behind the curve and not being aggressive enough. So we'll have to see how this plays out. So moving on, from inflation, where do we see it in the different areas of spending? And there's been a shift. And you can see this in recent months, a shift in consumer spending where you can understand we see spending on the left side here on the chart for gas has increased, given the high increase in oil prices in recent months, and non-essential spending has decreased. Now, what's interesting about inflation is historically, when you have the onset of inflation, consumer spending actually increases as people look to store up on goods. And the concern then is if my cash will lose purchasing power because of inflation, well, it's better to get your shopping out of the way, stock up on things that won't lose value. That could mean stuffing the freezer, buying shoes for your kids in the next size up, and so on. Unfortunately, this urge then only to spend like that boosts inflation then even more. But at some point, as inflation continues, consumers adapt their spending. And this is known in the trade as dialing out inflation. And it may be continuing to spend on essential items as we see here, but cutting back on non-essential items. But recent weeks here, we saw Walmart, Target, those earnings reports, And both companies said the inventory is building. And this might be a sign of both consumers shifting their spending. It's reducing discretionary spending. It might be improvements in the supply chain. So now, speaking of supply chains, let's look at this next slide. It has to do with delivery times. As you can see on this chart on the right side with that arrow going down, delivery times are improving. Now, what's too early to tell is how much of the delivery time improvement is from slowing demand and how much is from improvements in the supply chain. The labor market's strong, but you're seeing anecdotes of hiring freezes, layoffs in the tech industry. So if we go to the next slide, you're going to see that. In one of the most popular ways to track labor market health is the tally of initial claims for unemployment insurance benefits. It gets reported weekly. And while the level, it's near 50-year lows, we've seen a slight uptick in recent weeks. In the week ending May 14th, initial claims, they rose to 218,000. That's up 21,000 from the prior week, and it's at its highest level since January. So because of these supply chain disruptions have persisted far longer than many anticipated, the resulting shortages have caused inflation to be much hotter than what many expected. So the Federal Reserve has responded by tightening monetary policy. They believe that tighter financial conditions should cool the labor market, which in turn should then cool demand to a level that's more in line with supply. This should ultimately cool inflation, but the presence now, if you've got bloated inventories, shorter delivery times, would suggest supply chains, they're improving, and hiring freezes and layoffs suggest wage growth could cool. Now, assuming these anecdotes turn into economic trends, economic growth could come down soon thereafter. And, some of these things, these headlines, they're anecdotal in the moves, and we're seeing small changes in the economic data. But then again, though, most big trends start as anecdotes and small shifts in the data. So we'll see how this plays out.
So, in case you spent a lot of time at the beginning on inflation, and obviously that's something that we've been talking about for quite a while, and I think has probably been the main driver of what has caused volatility in the equity market. Stocks and bonds are both trying to figure out where the Fed's neutral rate is going to be and how that is going to either be effective or ineffective fighting inflation. And now I think we're starting to see a little bit of a shift from concerns about inflation or the idea that we're close to what's called peak inflation. And now we're getting into concerns about possible recession. And what I want to do now is take a look at some of the economic conditions that we're seeing right now and maybe trying to draw some conclusions on how close we might be to a recessionary period. Now, I think the other thing that's important to remember is that, recession is 2 consecutive quarters of negative GDP growth. But if you've got negative 0.5% and then you've got negative 0.1%, that's technically a recession. If you have negative 0.5% and then you have positive 0.02, that's technically not a recession. But at the end of the day, I think it's fair to just call it slowing growth. And, part of the goal of the Fed is to reduce demand, to reduce inflation. But if they go too far, then it could tip the economy into recession. And now I think with the reaction in some of the markets, particularly the bond market, and you're starting to see a little bit in the equity market, there may be an ongoing shift from concern about inflation to concern about recession. So here we can see that financial conditions in the U.S. Have already begun to tighten since about the beginning of the year. We've seen this line move down, and we're right at a level that historically has represented growth slowdowns, but it hasn't necessarily corresponded with recessionary levels. So we can see these gray boxes here denote recessions, and this level has gotten pretty much to -2. Great financial crisis, obviously it was way below that, all the way down to -12, and then during the COVID scare, we got down to -6. But when Casey and I were talking earlier, he made a pretty good observation here that even between these two times, we've had some periods where we've kind of gotten tight conditions, but it hasn't necessarily corresponded with a recession. And I think that some of that has to do with the time period from here to here. And granted, this is 1990 to right around 2010, was a period that wasn't necessarily dominated by monetary policy. The market and the economy was kind of allowed to stand on its own. Whereas since this point, and I don't mean to beat a dead horse here because we talk about this a lot, but I think it's a very important aspect of this to understand is the Fed has been extremely involved from this point up till now. And at all of these points in the past, they've been able to do something in order to counteract either in the market or they're in the economy by quantitative easing or lowering rates. The issue now is, will they have the flexibility to make that kind of impact with the inflation levels that we're seeing right now? And that's really yet to be seen. So when we take a look at economic leading indicators here, again, vertical gray bars denote recessions. So it's pretty evident here when you see these gray bars, you see this line, move significantly to the downside. Now this goes back all the way to about 1960. So it's a pretty good data set here. And when we come all the way to the right here, we haven't quite seen that downturn yet. Doesn't mean we can't get it, but so far the leading indicators right now are not giving us a clear picture that recession is quote unquote imminent. So if we were, kind of doing a checkbox here of definite recession signs versus not definite recession signs, I think this one would be the not definite recession sign, or maybe something in the middle. Now we've taken a look at the Atlanta Fed's GDP Now chart before, and as I mentioned earlier, whether we get what's technically termed as recession or extremely slow growth, I think that it's fair to say that most consensus forecasts going forward are continuing to be reduced lower. Now, just in the middle of May, the Fed had a Q2 GDP estimate of around 2.5%. Today, that sits at 1.8. So only in 2 weeks, we've seen that slash pretty substantially. Not only that, we had a Q1 GDP revision that came out today that went from negative 1.4 to negative 1.5. So not a significant move, but remained negative. So technically, if the Q2 GDP print comes out negative, you are now officially in a economic 101 definition of recession. Now, one of the things that almost always complements recession and can dictate a lot in terms of how deep a drawdown will be is earnings. And I understand that this chart is very hard to read, and I don't want you to focus necessarily on trying to read those numbers, because if you do, you're not going to be able to. But what I want to focus on here is the movement in terms of earnings revisions. Okay, so this goes back all the way to 2008. Again, gray bar denotes recessions. And what you can see is that most of the time when you have these recessions, you get big earnings revisions to the downside. We're going to talk a little bit about earnings later on in the presentation and how that might relate to what we would call fair value. But what we're seeing here is that coming out of the COVID crisis, we had huge negative earnings recessions, and that was pretty predictable when the global economy basically shut down. But coming out of that, and due to base effects, which we've talked about before, you had huge earnings growth, huge revisions to the upside, and now we've seen a peak and we're moving back down to the downside. So based on earnings growth going forward, I think it's going to be important whether these revisions get to maybe this level and stop, or they continue to move lower for what we've seen in a recessionary period. Because in the average recession, earnings estimates go down about 25%, which is a huge, huge number. And right now, 2022 earnings are estimated to grow by about 10%. So kind of the next domino to drop, so to speak, or the next real kind of inflection point, I think has a lot to do with earnings and how those are going to actually come in as we move forward. Now, we mentioned the idea of peak yields earlier, and we're starting to see some of that in the marketplace. So the blue line here denotes the 10-year break-even inflation rate. So basically, this is a market implied expectation of what inflation is going to be 10 years from now. And I realize that's a very long time, and the accuracy of predicting anything 10 years out is not very accurate. But as we have a market-related measure of that, this is going to trade off of what inflation expectations are going to be going forward. So what we've seen is a little bit of a peak here, but then also you see the yield on the 2-year treasury after it's gone almost vertical in response to expectations around what the Fed is going to do in terms of getting to the neutral rate. We've started to see it come down a little bit. And as these two have started to come down in unison, you're starting to hear more chatter about the idea of, have we reached peak yields? And if we have reached peak yields, is that a sign that maybe we are closer to the end of this bear market sell-off, whatever you want to call it, as opposed to the beginning? Now, what are yields saying with this? So this is just another look at the 2-year, has come down from right around 275 all the way to 250. But then you look at the 10-year, which has come down from about 3.2 all the way to 276. And then the 5-year forward inflation expectation. So again, this is the market implied inflation rate on a 5-year basis, has also come down. So as you've started to see soft economic numbers come in, we had a new housing report that I think came out on Monday or Tuesday that was absolutely atrocious. So you're starting to see pockets again of poor economic data. And as that has happened, you're starting to see yields slowly move their way down. And along with that, you're starting to see inflation expectations starting to move down as well. Now, some people may be asking, why is that? Well, first of all, if inflation starts to come down on its own, it gives the Fed room to not have a neutral rate that is as high as maybe the market expects right now. So if everyone is saying, hey, the neutral rate is going to be 3 or 3.5, and it only ends up being 2 or 2.5, that is significantly less tightening than's being priced in at the moment. So that could be a positive for risk assets. Now, granted, if it doesn't come packaged with a bad recession. The other thing is, 10-year bonds specifically trade on the expectation of future economic growth. So if we have low economic growth going forward, or even a recession, you're going to see money flowing into bonds. And I know that sounds crazy with the inflation that we've seen and the performance that we've seen in fixed income. But bonds are a natural defense against recessionary periods. And if we have growth that is going to be below trend or around zero, we're of the opinion that at worst, you have seen a top in yields, and at best, you're going to see yields start to move lower. And that should help, bond positions, particularly those that have a lot of duration in them, which have been hit pretty hard this year. Now, we can officially call this a bear now, whether you want to call it a bear, a significant correction. I don't think the nomenclature really matters. I think the reality is that it's a pretty steep sell-off. The difference between barely going over 20% and being at 19, I don't think is that much, but it certainly brings out the headlines. So as we've seen here, this is counting the number of news articles mentioning bear markets. Clearly the most we've seen since the COVID bottom. So obviously it's on everybody's mind right now. And the reality is we've only actually been in a bear market for a few hours. We breached the 20% level in the S&P for a short amount of time, but then bounced back and finished over it. Now, when we think about
unfortunately, journalists can be guilty of recency bias as well. Of whatever is in the news, they will produce more articles about because they want eyeballs. So unfortunately, fear sells. Exactly.
So now we talk about bear markets a lot and corrections, and you've probably seen a lot of things, not only in the media, but we brought them up as well, that having a 10 to 15% correction is not abnormal in the market. It actually happens quite frequently. What happens a little bit more infrequently are bear markets, and specifically those that maybe extend over that 20% threshold. And if you look at the chart here, we've got all the drawdowns listed back to 1965, and this line denotes that 20% mark. as being a bear market. So you've got 1, 2, 3, 4, 5, we'll call this 6, 7, 8, 9 instances here. And I guess we can include this as the 10, that we've had a quote unquote bear market in the last 60 years. But if you look, there's only been probably half of these that have actually gone over the 20% time, or excuse me, the 20% threshold and stayed there for any significant amount of time. And I think part of the reason is that, there's a psychology around once that 20% gets hit, you get a lot of buyers that step in for whatever reason. And whether that's happening now, we're not quite sure yet. We've seen mixed signals on that front, but having a market go from 20% to 25 or 30, and when we're talking about that, we're referring to the S&P right now, is not necessarily a common thing. Now, when we talk about equity returns this year, we have seen some bifurcation in where the equity returns are. So these top, returns here, which on a relative basis have been the strongest performers, are on the value side. So your large cap value ETF here, you've got the Dow Jones Industrial Average here. And then right here, surprisingly, maybe to some people, is you have the international index. Remember, international is a little bit more value biased here. So international has been kind of a black eye in a lot of people's portfolios and minds for what feels like the better part of 10 to 15 years. But actually this year, international has held up pretty well coming out of the crisis or the initiation of the crisis in Ukraine, I should say, since it's ongoing. S&P 500, 16% down as we printed this out this morning. So again, we did reach 20% at some point, but as of the close today, I think we've had about a 4 or 5% rally back from that point. Then you're getting into things like small cap, which are more economically sensitive, right around 20. And then all the way down here, you've got the NASDAQ 100 or the triple Q, and then the large cap growth ETF. So not surprisingly, as rates have moved higher, and as we've had kind of a reevaluation of pricing in some of these tech areas with higher rates and lower liquidity, it's not necessarily surprising to see that all the way down here for the time being. Now, I'm going to let Casey run through this slide here because he came across this earlier today, and I think it's a good piece.
Well, this was data that I was aware of, but it's a pretty mind-blowing chart. And this is looking at the stock market, companies that pay dividends and companies that don't pay dividends. So you're going to see a green dot on the bottom left-hand side of this. And this is looking over the last 64 years. And stocks that paid no dividend had returns that were no higher than the market. So when you say no higher, if you go from the green dot of the market, and you're going to see that return was just around 10.5%, maybe a little bit above, and you go far to the right, and you're going to see no dividends, it pretty much has a similar return. But when we look at the scale at the bottom, now we're looking at the risk. Risk is measured by standard deviation. We go from the market of between 15 and 16 to no dividend paying stocks are at 23. That's a substantial increase in risk without really much reward you're seeing at all in return. But then you're looking at all the rankings of various areas of the market that pay dividends. And you don't necessarily have to be in the highest dividend yielding areas. Unfortunately, this chart doesn't show maybe the dividend growers or the speed of growth. But I think the important concept here is to understand and look at, are you being rewarded for the risk? And the reason this particular chart was such an eye opener to me is you forget sometimes. And you go back to the 2000 to 2002 era, just in the last year. I mean, there were stocks that during the pandemic went up 2 and 3 and 5 times, but they really didn't have any earnings. It was more of growing revenue, only to see those stocks then go down and go down to pre-pandemic levels and drop 60, 70, 80+%. And that's serious volatility, both in the upside and the downside. Sometimes we just forget about the downside volatility associated with it. So at HCM, a big part of our investing style tends to be more value, tends to be more dividend biased. And the reason why is just this great combination of return and stability. And so I saw this chart and I thought certainly something worth noting, is something that we talk a lot about returns, but sometimes the focus isn't enough about risk to get those returns. Something I think we'll continue to have more discussions with clients about too.
Thanks, Case. So when we talk about returns, when we talk about rallies, a lot of the big question we get a lot of times is this over? Have we seen a bottom? You're going to hear lots of calls for bottoms, and we internally have things that we pay attention to that may not necessarily call a bottom, so to speak, but tells us that it's probably time to start to put some money back to work. But you can get a lot of false starts in bear markets. Now, this shows the great financial crisis that S&P was down close to 60% from peak to trough. And again, I don't want to suggest that that's going to happen again. But what I want to suggest is if we are in something like that, having a 8, 12, 24% rally inside of this is not abnormal. So just because we see, the market begin to rally and take off, and maybe it's up 10% and everyone's feeling good, that's not necessarily a sign that things are completely over. And the most vicious rallies that you see are most oftentimes in bear markets. So I think there's still a lot to be determined in what we're seeing right now. Yes, we've seen a pretty good pop here over the past few days, but it's important to remember we were also very oversold. I think we've been down for the last 7 weeks. 8 is the record. So we're coming into month end, so you may see some trickery here to boost some fund managers' positions in their month end reporting. But just keep in mind that the all clear doesn't necessarily just come from big rallies within these type of drawdowns. And then the equity volatility that we've seen so far. This is a chart that's updated. So the beginning of all this, down 12.5, then we're up at 11.5, then we're down 15.9. And now if I put another arrow in here, based on today's close, it would be up about 6. So we're really all over the place here. And I think it's important to remember that the math of loss exists. And basically what it says is that, if you lose 10%, you don't need 10% to get back to even. You need 11. If you lose 50%, you don't need 50% to get back to even. You need 100%. So, while these things may add up to 0, they certainly won't add up to a quote unquote positive return if just based on the loss of math in here, or the math of loss, I should say. So equity volatility remains high. And even with a little bit of bounce we've seen, it's certainly not something where we're saying, hey, we're out of the woods right now.
Doug, this seems like it's following more of, the last 2 moves down in the market between the pandemic and 2018 were more like V-shaped type recoveries, and you just don't see V-shaped recoveries very often. And it really tends to be a little bit more of this type of grind of down and a little bit of recovery and then down. And it takes time for this bottoming process to work out, and it still may take a while.
Yeah. And then, most oftentimes you'll hear this referred to as a W-shaped recovery with these kind of jagged lines in it, as opposed to, you mentioned that V-shaped bottom. Now, trying to put this correction into context historically a little bit. So again, we talk about recession and why we think it's important, because recessions have historically coincided with the worst drawdowns in markets. The recession median or non-recession median drawdown going back, I think this goes back to post-war. So I want to say the 40s. These are not in order, so I'm trying to find the lowest one. So I think 46 we'll call. So nonetheless, a big chunk of time here. So non-recession median, about 12.5. So if we don't have a recession that corresponds with this, we've already moved past this level. Currently about 18.7 when this was printed, a little bit better than that now. But the recession median is about 23.9 or 24%. So you can see, with or without recession, there's a big difference in terms of what that drawdown looks like. And all of these here, or all 5 of the largest ones have been recessionary periods, as denoted by this kind of peaches color where the worst non-recession episodes we've ever had was 1987, which was the Black Monday, and then 1961. You know, now taking the return portion out of it, you can also see the time frame. So this shows correction in terms of length of time in months, and then the subsequent recovery. So the last two real bear markets that we saw, 2000, 2007, as Casey was mentioned in the very beginning, the tech crash was 31 months. Great financial crisis, 17 months from peak to trough. So very long times and very long recovery subsequently. The latest ones that we've seen, 11, 18, 20, I guess now even, you've had the Fed come in and do something to save the day and cause that V-shaped recovery. So 5.2, 3.2 in 2018, barely a month during the COVID crisis. Right now, we're about 4.6, so it probably feels long in the moment. But again, if we're not in a situation where the Fed can come in and do something, this could drag on for a while. Doesn't mean it has to go down 40%, but it also doesn't mean it has to go and come back straight up and have everything be okay. So I think patience is going to be a virtue in this type of market environment. And we can see here that some of the the ones that we mentioned in the past years, so 61, about 15, and some of these other recessions, it's not abnormal to have long periods of drawdowns. And when we talk about what can cause a bottom, what can lead to a bottom, usually sentiment gets really, really bad. But there's still that buy the dip at all costs mentality in the marketplace, and we can see it here. So this security is TQQQ. So this is a 2 times bull leveraged NASDAQ ETF. So it basically gives you the daily return of the NASDAQ twice and then resets at the end of every day. So it's kind of hard to read the pricing here, but what I can tell you is this is down about 67% in this time frame. This is year to date, all right? So these green bars denote fund flows into this ETF, all right? So you look at this and you say all the way down, as this thing has just been absolutely obliterated, you have had really, really strong fund flows going into this product. Now, I know the old adage of buy low, sell high makes a lot of sense here. And I guess you could make the argument that that's what these folks are doing here. But it's the psychological aspect of it is market bottoms usually aren't denoted by this type of fund flow into a product that's getting absolutely destroyed like this. It should look the opposite. It should be big red bars where people just cannot take it anymore. So I think there's still a little of that buy the dip, the Fed's going to step in and do something mentality in the market that may be holding this up a little bit. And I think it also creates a little bit of danger here. And I think until we see that psychology shift, I don't know that we're able to have that selling exhaustion that has marked every major bear market that we've seen. So again, you look at the sentiment here. So this is Michigan consumer sentiment in blue, and this is the Association of Individual Investors asset allocation. You're still almost at peak equity allocations with very poor sentiment. So I think everyone's telling everyone, oh, I'm really bearish, but I'm really scared to sell my equities because I don't want to miss the rebound. So there's a little bit of disconnect there. And it's not that we can't have a recovery off of something like this without, really, really bad sentiment and that extreme washout selling, but almost every 20% drawdown or greater that's existed in market history has bottomed out with that type of kind of capitulation at some point. And we've seen those numbers get close, but this has been a really, I don't throw this word around lightly. It's been a really orderly sell-off. You haven't seen a lot of, VIX spiking. VIX is just a volatility index. And, those are the type of things that I think need to really hit panic levels before I think we can say, okay, it's time to strategically start to put some money back to work here. So with this sell-off, we've seen valuations continue to come down here. So the black is denoted in the US. So going back to 85, still at somewhat elevated levels, but again, emerging market and developed market or international assets is still extremely cheap versus the US. So we want to continue to drip that into clients' minds, because at some point we may look to increase our international allocation. And a big reason for that is this relationship right here and this large gap in the valuations between US and international. Now, if we just focus on the US, I've been hearing a lot of people talking about fair value and what is fair value. So here's the forward S&P or the forward P on the S&P 500 going back 10 years. And based on where we are right now, we're right around the 10-year average, which is about 17 times earnings. So if we think, all right, what is fair value then based on where earnings are right now? So the 2021 operating earnings for the S&P 500 was $208, right? So that is a number that has already happened. If we take the average market P of 17 times and then base that on the current level of the S&P right now, which as of close was about 40.60, that gives us 208 times 17 gives us a fair value of 3,540 on the S&P. So a little bit more than 9% below where we are right now. Now, S&P earnings are expected to grow by 10% this year to 229. Okay. So if we get that 229 number and we apply that average P of 17, we're at a fair value of right around 3,900. So not very far off from current market levels. And again, stocks don't need to hit fair value. Fair value is more of a longer term look at the market, but they can stay above or shoot below that. But let's say that earnings only grow 5% this year. Fair value looking at right around 3,700. If they don't grow at all, 3,500. And if we do get into recession and they actually contract a little bit, and this is a pretty generous offering here, and they go down to 195 at fair value, you're looking at around 3,350 or about 15%. Now, I know some people may ask, well, what are your predictions for these levels? We don't really have any predictions for these levels. This is more of just a baseline. When you hear people talking about fair value, what it actually means and refers to a quote unquote normalized PE ratio, and then taking that back to different earnings levels. So as we kind of wrap all this up, we like to go through the bullet points of how does this obviously get better, and then what could make it get worse. So Casey, I'm going to let you take care of the how this gets better stuff.
Sure. So inflation, it needs to soften, preferably from the supply side, leading to the neutral rate being lower than the current market pricing. And the consumer remains strong in the face of higher costs. That's to be determined. We'll see. And the Fed remains committed to reducing inflation, but takes a less hawkish tone in their guidance. Hopefully, the Fed will get help from some of the data that can allow them to do that. In corporate earnings and economic growth, they remain above recessionary levels, or at even if they are very, very, very low levels of growth, then that's still, so we could still continue to remain out of a recession. Yields stabilize, and heavy market selling that indicates exhaustion. So those are, I think, a lot of the positives. Certainly, if Putin were to suddenly end the war, whether he wants to claim victory or not, certainly that could be something that could be another thing that could add to the positive side of the equation.
Well, let me just touch on the last bullet point here, because I know that seems somewhat counterintuitive that we would say heavy selling or a further market drawdown could make this get better. But as I mentioned before, when you see signs of selling exhaustion, that's usually a good indicator that things are, the worst is behind us, and it's giving you, a good opportunity then to start to put money back to work. It's not necessarily calling the bottom, but it's hitting signposts that say, okay, 6, 12, 18 months out, there's a really high probability that money being put back to work at that point is going to be higher in the future. So just wanted to put some detail around that. So how does this get even worse? Because it's been pretty bad so far, but how can this get worse? So if we see inflation staying elevated, so obviously 8.5% inflation is a high number. If growth rates or inflation rates were going to start to come down, we'd like to see them, get back to that 2 to 3% level. But even I think people would take 4 or 5% right now, as opposed to having things stay at 8 or, God forbid, go even higher than that. We mentioned corporate earnings and growth. If those were to slow significantly, particularly on the earnings side, I think that would be the next knock-on effect here, and what could cause some additional market selling and repricing. Any kind of policy error from the Fed, either they're too passive, which causes inflation to go out of control, or they're too aggressive, which, while we'll take care of inflation, would also crush the economy into a recession. Yields continuing to move higher. So far, we haven't seen that. We have seen that peak in yields so far. Credit spreads begin to widen significantly. So that's one thing we haven't seen happen at all. The credit market has remained pretty orderly, and we haven't seen any issues there. Unemployment rates start to move higher. So we've seen a little kick up here in the initial jobless claims over the past few weeks. But if the unemployment rate started to move higher, it could indicate that we were beginning to see layoffs and a little bit of a labor, I don't want to say crisis, but most recessions involve people being laid off and unemployment rates moving higher.
So from the HCM case, I think the Fed remains very deliberate in their fight against inflation. We still think this market is going to play out for a while, where it's going to be a struggle. The inflation concerns are not going to go away for a while. That's going to take time to work itself out. So you're still going to have this worry about recession. That's going to linger for a bit. But the bond market, which is a change from what we've seen in the trend here in recent months, has started to shift a little bit. And it's starting to signal potentially slowing down, or a transition from inflation being the biggest concern now to maybe recession, or the risk of a recession, of slowing economy. That may be more the shift right now, but at least now you're seeing some appreciation bonds, and bonds are acting more of the stability and helping offset some of the issues in the stock market right now. And then geopolitical concerns, they're going to remain in focus as long as right now we have the war still with Russia, and what it's going to be doing to the supply chains. With the COVID situation, China, that still adds some pressure. COVID unfortunately has not gone away, and we'll have to see how this plays out later in the year when we have colder weather. And then the market sell-off. It's been orderly, as Doug mentioned. We've not had these washout selling. So the increasing likelihood of more of this W-shaped recovery, where it takes time for this market to play itself out before things can progress forward, and we're likely to retest lows. Hopefully we'll see that accelerated selling, that maybe things wash out, but it's going to look more like maybe some past bear markets versus being opposed to the 2018, 2020 quick V-shaped type bottom that we've seen. So this is going to take time. It's not going to be a quick turnaround in the market likely.
So where does that leave us going forward in terms of portfolio positioning? So we remain, positioned for a high inflation regime. We expect the Fed to continue to tighten with the possibility of a recession, which has led us to maintain an underweight equities position. But we also think that the idea of inflation peaking is not out of the question. But until we see that actually in action, I don't know that it's going to cause us to make major changes. We still have a value bias, but we are watching that cyclical value closely, because if we do get into slower growth and into recessionary periods, cyclical names, particularly in the value area, might struggle a little bit. Slower economic growth may provide an opportunity to add select high quality growth. Not necessarily the stuff that was up 200, 300, 400% that Casey was mentioned during COVID. And is now down 85, 90%. But the companies that have been established that have good free cash flows and a lot of pricing power in the market. Because again, in a slow economic growth environment, you want to have some exposure to growth to be able to generate earnings kind of in any environment, so to speak. And then, as we mentioned before, consider adding risk back in the models if we see signs of selling exhaustion. This would not be a bottom call. It's simply a realization, or a recognition, that I should say, that we feel adding money at that time will be advantageous 12 to 18 months down the road, based on historical signposts and some of the work that we've done studying those type of market moves. And then finally, a really good quote from Charlie Munger. So a lot of people with high IQs are terrible investors because they have terrible temperaments. You need to keep raw, irrational emotion under control. And a lot of times in bear markets, they are driven by emotion. So we want to make sure that we're looking at things as objectively as possible and trying to pull the emotion out as much as we can. So with that, we've got several questions here that I want to try to get to. So let me go ahead and try to run through these. So the first one asking if there's a reason to change personal timeframes in view of the potential of a possible recession or a market downturn. So I think maybe that is, should there be an allocation shift in light of what we've seen with some of these forecasts? I would say that we've already kind of taken steps to reduce risk a little bit, and I think if you were closer to retirement, then it's certainly worth revisiting those assumptions that you may have made in your plan and looking at things like your risk tolerance, maybe going over that again, and making sure that your cash flow projections and things like that on the planning side are really kind of what I would say airtight in order to weather something that might be a little bit worse than I'm not saying we're expecting something bad, but the worst case scenario, so to speak. In case, can you speak to that at all?
So I'm going to apologize, Doug, to you. I was kind of scrolling the list of some of the questions. So if you don't mind repeating that, because I was scrolling through to make sure that there were some other questions to get answered.
Yeah, sure. So it's basically a question around, if we're worried about recession going forward, does that change the time frame in view of potential problems? So the way I kind of read that is, should there be an allocation shift in terms of judging that outcome?
Right. I think for most people, probably the answer is no. If there's something coming up on the horizon within the next few years that capital is going to be needed or planned for, then I think that the answer is yes. Or we certainly need to have some dialogue around that. But for most people, I would say no. It's just because, before, I guess from an airplane analogy, before you get in the air, you've got a flight plan and you plan for the worst. And as now we're in the air, and now we're experiencing turbulence and things, and we're already kind of going through our plan that we already had on the ground. So if you need cash flow or you need funding, we have more safe and secure areas to be able to provide and fund that from. But from the standpoint of timeframes, we don't see that we need to make any other changes. That's something that on a one-on-one basis, we should be in tune with you on in meetings and dialogue of understanding your personal needs and if are there any changes that we need to incorporate. But from a global standpoint, I think for most people, the answer is probably no. We're already making those changes. We've got some cash in the portfolio now. We've made allocation changes earlier, several months ago, to be more defensive, and we've been able to benefit from that.
So one point I want to make too, not a question, but an observation that somebody caught, which I misspoke regarding the TQQQ. It's actually not a 2 times leverage, but it is in fact a 3 times leverage. So if 2 times wasn't enough risk for you, you can go in and put money into a 3 times leverage. So probably makes the point of the slide even better, that money is still flowing into very risky areas of the market.
And there were some questions, Doug, I know about some individual growth and tech stocks and things. And while we tend not to talk about individual names on webinars or public and do that more one-on-one, it's just more of a compliance issue. I guess I would add to that just what Doug mentioned earlier, is that a lot of the names that were listed here are more in the quality growth. And from a quality growth standpoint, those would probably be names that, should we have more of a slow growth type of environment, economic environment that you mentioned, Doug, then these would probably be companies in that sector, in those areas would be ripe to do well, of companies that you mentioned that can produce earnings in any environment and grow faster than a lot of other sectors. So certainly that would probably do well. And yes, we would agree that if the Russia and Ukraine stop fighting, you would likely see a drop in oil prices. Does it mean that you need to completely sell all oil stocks? Probably not. Does it mean for some, if they end up being a little heavier in oil, it could make sense to trim oil stocks? But certainly we would expect oil prices to drop and the market would start to move accordingly, even though earnings are probably still going to be pretty good for a while. You would expect the market to already start looking forward and anticipate what's likely to come down the pike. So yeah, we would likely see those stock prices start to deteriorate some.
The last question is what percentage of a family's account should be in cash right now? I mean, it's a hard question to answer on a general basis because everyone's situation is different right now. I know for us, when we have our quote unquote fixed income allocation, we have roughly 6 to 8% of a client's model in cash right now. Depending on the circumstance, it could be a little bit higher than that. But before, I think that was done with concern around rising yields. But I'm not sure that that's the case anymore. I think if we start to see growth slow down, that you could see yields start to move lower. So I don't think you need a giant cash allocation unless you have some kind of big expense or outlay that's coming in the next 6 to 12 months that you're going to need that money for. But a little cash on the sidelines right now, certainly in the face of all this uncertainty, is not going to be the worst thing in the world. So Casey, I think that's all the questions we have for today. And I think we're right against time. So if you want to go ahead and take us out. Yeah, I think so. I think the only other mention question wise happened to be regarding old fashions over Twinkies. And so that's probably a true statement, or they might be a great pairing. So we'd have to ask at down at the what's the Doug the what's the name of the event place down in Northern Kentucky that does the cooking and culinary, and sometimes they'll pair wines and food. So that might be a question for them if old fashioned. You're talking about New Riff? Yeah, New Riff and down at the Party Source. So it might be a good question for them to see if pairing those two together is a good pairing or not. So again, thank you so much for the confidence, the trust that you've placed in us. If there's other specific questions, because there was a lot of great questions, but a lot of these oftentimes are more personal. Those are ones that we're glad to answer on a one-on-one basis and make sure that it aligns well specifically with your plan. So again, thank you so much for being with us today.